In this video, you will find what are the best Canadian REITs to buy in this wild housing market. For those that wouldn't know what is a REIT, it stands for a Real Estate Investment Trust. Basically, it is a company that owns, manages, operate and finance some real estate properties. Just like mutual funds, the REITs are using the capital of the investors to invest straight in those properties. But what is really interesting about those kind of companies is the fact that they are giving some high dividends, way higher than what the average companies are giving. In fact, with their structure, the REITs are giving between 80 to 95% of their net income after expenses straight to their shareholders. However, for the Canadian, those dividends are not eligible for the dividend tax credit. That's why it could be super interesting to hold them in your TFSA. So personally, I think that it's a great opportunity to buy real estate without having to put some hundreds of thousands of dollars. Especially right now, I think that it's a great alternative to buy real estate since the housing market is super crazy and many young people that at the moment are trying to buy their first house will have a lot of difficulties to do it. And that's why they might need to take a rent eventually. So taking some REITs and investing in some REITs could be a great alternative to it. So now let's jump to my pick number one. As you guys might know from one of my previous videos on my favorite Canadian REITs, RioCan is the number one pick on my list. This company, created in 1993, is currently the second largest real estate investment trust in Canada. They notably have many different shopping markets all around Canada with tenants like Winners, Metro, and Canadian Tire. RioCan has a vision to create space where everyone can prosper and also a mission of sustainable growth. RioCan has about 207 properties which represent about 36.4 million of square feet of aggregate net leasable area. About 91% of their annualized revenue comes from the 6 major markets in Canada and the business worth about $13.9 billion. And so they have an occupancy rate of about 96.8% with a strong demographic profile within 5 kilometers of their centers. Because as we can see, all their assets are split into 6 different big Canadian markets. So in Vancouver, Edmonton, Calgary, Toronto with about 50% of their revenues coming from there, Montreal and Ottawa. And so 90% of their property comes from the retail, about 7% from the office, and the last 2-3% from the residential rental. And here we can see that they have a great diversification in the revenue from their tenants. So it comes mainly from the grocery, pharmacy, liquor, the essential personal services, and also the specialty retailers and the value retailers. And for the fourth quarter of 2021, they have had about $600 million of net income with $700 million that is coming from the operating income. And they also have a super good payout ratio of about 62.6%. What I really like about RioCan is the fact that they have a lot of place to grow in the future, but they also have a huge dividend. Indeed, this represents a great opportunity to receive some monthly cash flow from this company. Of course, with the pandemic, they have been forced to cut their dividend because they have a lot of different retail investment like shopping malls where the shops were closed during a lot of the period of 2020 and 2021. But I personally believe that eventually their dividend will come back at 10 and maybe 12% as it was before the pandemic. For my second pick, we are going into the residential sector with the Canadian apartment properties. This REIT is the biggest of its kind in Canada and it has more than 67,000 managed suites all around Canada, the Netherlands, and Ireland. This REIT, created in 1997, has more than 17 billion in assets. Just like RioCan, their big market is located in Ontario with about half of their net operating income that comes from this province. And their other big markets are in British Columbia, in Quebec, and in the Netherlands. And we can see that they have an interesting net operating income of about $600 million, with the majority of it coming from their residential suites. So in the last quarter, we've seen an increase of 7% in their operating revenues with an increase of about 3% in their net operating income. This this is a lot due to the fact that they are continuing to increase their portfolio, as we can see over here with the 2020 acquisition compared to the 2021 acquisition. And even if we can see that they have a smaller dividend yield of about 2.78% compared to the other competitor in its field, we see that this company has been growing its dividend year after year, and they haven't cut it in 2020, which is a really great news. Just like Raucan, I believe that CAR is really an interesting pick to watch for your portfolio in the REIT sector. It gives you some great exposure to the residential sector, and also knowing the fact that in the past couple of weeks, this stock has been dipping a lot, I think that it could be a great buying opportunity in the next couple of days. And this is also super interesting since the Canadian immigration has been booming in the past couple of years, so all those people that will come will need obviously a place to live. The only con that I would have for this kind of company is the fact that they have a lower dividend compared to its competitor, just like Raucan. My third favorite Canadian REITs at the moment is Granite. This company that owns more than 134 different properties all around 7 countries, including Canada, the US, Germany, and the Netherlands, worth about $6.2 billion. It covers about 55.9 million of square feet, and it has an occupancy percentage of about 90.6%. Just like Raucan, Granite has many different retail tenants. For example, they have Home Depot, Walmart, and Cardinal Health. You can also see that you have a good geographic diversification with about 34 properties located in Canada, and their big majority in the US, about 60 properties, and the rest is in Germany, Netherlands, and Austria. And as you can see here, the majority of the income and of the properties are located in the US. As we can see here, the investment properties of Granite are growing pretty fast in the past year, which is of course reflect in the total assets of the company, which is also reflect in the net operating income, as we can see that have grown in the past year compared to 2020, where the rental revenue has increased more than the operating cost. And we can see here that the net income has completely exploded in 2021 compared to 2020. And Granite are also paying some monthly payment that have just been increased at the end of 2021 to $0.2583 per month per share. So the big pros of this kind of company is the fact that it is more diversified globally than a Raucan, that it acts in the same retail sector. But keep in mind that this company also have a great dividend and a great potential of increase in the dividend, and also a lot of potential growth in their stock. For my fourth and last pick, I've long hesitated between Dream Industrial and Smart Center, but I've decided to choose Smart Center. Founded in 1989, Smart Center is really a pioneer in the retail sector. It owns about 174 different properties all around Canada that worth about $11.3 billion. They have about 34 millions of square feet leasable to tenants just like Costco, Home Depot, and Walmart. Once again, we can see that the majority of their revenue comes from Ontario with about 60% of them, and in second position you have Quebec and British Columbia in third position. Now if we compare the net operative income of 2021 compared with 2020, we see that they have increased their net operating income of about $8,000. And this company is also paying some monthly dividend of about $0.15 per share per month, which is equal to about 6% per year. And what is really interesting is the fact that this company hasn't cut at all their dividend throughout the pandemic. So you see, this stock is really interesting. It has some huge and important tenants, and I think that it has a lot of potential power of growth, and also a great dividend at the moment that is also paid monthly. Just to verify if I had some good picks, I went on the Canadian Cap REIT index from Vanguard, and I saw that all of them were there. I think that this is a great alternative instead of buying the stocks, but personally I really prefer to buy the stock instead. Indeed, I just don't want to pay all the different management fees, and I want to enjoy all those juicy dividends straight into my TFSA where it's not going to be taxed. But oh boy, that I've done a great job buying Raucan 2 years ago. That gives me more than 70% of growth plus the dividend. And so if you want to understand how I made it, just go watch out the video that's gonna be right over here, and I will see you there. Peace.